Welcome to the Home and Finance Show, and thank you for tuning in. I'm Janice Bradley, owner-broker of JB Real Estate Consultants, and joining me is my co-host,
Diana Rice-Wilkerson, lender with Fairway Independent Mortgage.
We are your seasoned, trusted advisors, committed to personally navigating you through the home buying and home lending process. This show is designed to provide you with the current and relevant information about different aspects of home buying, home selling, and lending so that you're knowledgeable when making decisions for you and your family. You can also hear us on Saturdays on Praise AM 1310 and also 95.1 FM. That said, if you are in the market to buy, build, or refinance, we'd love to represent you. You may reach us at the contact information below. Now on with the show. Hello, Diana Rice-Wilkerson and Shelley Goodsman.
Hello.
We've got a little bit of a show today.
We do.
I'm going to call it Inquiring Minds Want to Know.
Oh, I love it.
Because that always works.
Yeah.
You know? What does that mean? We want to know what you're talking about. We've got some questions, and we know that Diana Rice-Wilkerson is going to be the one to answer them.
I'm going to do my best.
Okie dokie then. So there's no telling what's going to come out of this fishbowl. Shelley, you want to pull out a question first?
I would love to. And these are like questions you get on the radio show. So these are live, real,
Yes.
like this is life. And so
This is life.
this is life. So let's see this first one here. I put it on mega font so we can all read it. Okay, so my parents are in their late 70s and in pretty good health. Their home is almost paid off and in great condition. My concern is they have very little income from Social Security and retirement. But we've been hearing about the reverse mortgage, but just not sure if it's a good option. And we're also not sure if it's safe, and they would like your advice.
That's a great question. Very good question, and I think a lot of families are in that situation where you may have aging parents and they have their homes and possibly they're paid in full or have a low balance. And my response to the question is, number one, they are very safe if you are getting a HUD reverse mortgage, sometimes called a HECM.
Okay.
That's not to say a non-HUD reverse mortgage is unsafe. I'm just saying the ones I'm familiar with is the HUD HECM.
And they're safe because?
And they're safe because they're backed by FHA, the government.
The government.
If you're not dealing with a government product, just do your due diligence and make sure that you're clear about how the program works. What would be a possibility in that situation with a solid equity situation, low balance, good value, is possibly the opportunity to refinance the current mortgage, eliminate the mortgage payment.
Okay.
Also, that would bring cash back into the house, along with establishing a line of credit for the additional equity that's not needed at this point. And in that case, it's a line of credit, and the borrower just draws down on the line as they need to. So if
like a credit card, but it's tied to the equity in your home.
like a credit card, some people opt to maybe get a monthly draw, just set their budget up and say once a month I'm going to draw $1,500 or $2,000. Others just set it there until they need it. They don't have to draw it at all. But it's nice to have, in that situation, would be nice to eliminate the mortgage payment and have a line of credit there so that they can draw down as they need it.
I was just thinking of something, like when they're talking about the parents they have very limited income with their Social Security. A lot of times for a mortgage, obviously, you have to qualify for that mortgage. And if you have a limited income, they might be intimidated or unsure of that. But I know on your series that you've done on retirement mortgages that your income isn't taken into consideration. It's not a quantifying or qualifying factor.
Not for debt ratio purposes.
Yeah, for debt ratio.
That's right.
Purposes.
Not for debt ratio purposes.
But most people think absolutely you have to be able to afford it, but you're really lending it to yourself. It's your own equity that you're lending yourself. So
I think a reverse mortgage is probably going to become a retirement mortgage because there's a new name out there.
Yes.
It's like retirement HECM mortgage, because what we're trying to do too is help people understand who the product is for. You have to be 62 years or older for the HUD HECM. You have to be 62 years or older. And the other thing is that, we are living longer, right? We like staying in our houses, right?
Yes.
And where is our equity? In our house. And so this is a way of tapping into the equity and making that equity work for you, and at the same time improving your quality of life.
love
And
it.
I'm happy to talk with anyone who has more questions about it.
And who wouldn't want to?
Exactly.
Who wouldn't want to have a mortgage payment?
No mortgage. That's a winner right there.
Exactly.
All right, well, you pull a question here. Let's see what else we've got in here.
Let's see what
In
we
that
got.
little fishbowl
Yes,
of
I
goodies.
love the fishbowl because really. Next time we should have water in it.
But you know,
But then
this is what I love. You know how Diana always says you got to live somewhere, even fish.
have to live somewhere.
to live
somewhere.
So-
There you
We've
go.
killed the fish about now, that's for sure. All righty. Okay. So glad this is some big print. So Diana, I want to buy a home but have somewhat an unusual situation.
Okay.
I was incarcerated for several years. I got out last year and have been working on the same job ever since. I'm afraid to apply for a loan because I know the underwriter will see that I got in trouble in the past, and most likely will deny my loan. How do I get around this? Do I need a co-signer, or will that help?
What a great question. And you know what? The good news is you may not need a co-signer at all. Certainly not for the incarceration situation. That information is not on the credit report, I would imagine. Some people think it is. The only thing we're pulling is credit report, liens and judgment report. As far as employment history, because there are times, and I actually have made loans to a couple of folks who have been incarcerated, and what I like is they've told me, Diana, I
Yes.
need to tell you something. And I like them telling me, number one, because I can assure them that is not going to be the issue. Now let's talk about your employment history.
Right.
So if that employment history, like say the person's been on their job, and I can't remember this case, but it's not been 2 years. What we're looking for is A, stable employment, like anyone else. And then we're looking for sometime in your past where you worked at least 2 consecutive years. It could have been 2 different jobs. It could have been 3 different jobs, but it was consecutive. So you moved from one job to the other, or you were on the job, for 2 consecutive years. That shows stability. That shows that you have the
Yes.
ability to be committed and stay on a job. That's why that's important. It doesn't have to be the current job you're on right now. Although we would want to see if you've not worked, let's say, for a while and you've been back to work for less than 2 years, you need to be back to work for at least 6 months. Okay, at least 6 months. A year, everyone's situation can be a little different, so it might end up being a year, just depending, but at least 6 months, and we can move forward. But the incarceration part does not come up, not at all, period.
Or a felon or anything of that nature?
Nope,
That's
not
great.
at all.
That's great
So,
news.
Something you don't even have to be concerned about. It's one of those things where you qualify like everyone else.
Yeah.
And then what
As it
I've
should
done
be.
even for my buyers, because no one really wants, when we ask what happened, the gap in employment, personal situation that prevented me from working. That's it.
Okay.
And that's all you have to say. No
Yeah,
one's into
like it.
your details or your business.
I like that.
More importantly is
I'll have
like,
to
what
use that
are
for
you
myself. Should not be helped.
more importantly, and my customers tell me where the bodies are buried. Okay,
Yeah.
I'm going to let you know whether or not
I
we
like
even need to
that.
dig them
I
up or
like
not
that. Yeah.
and move them. But anyway, you got to tell me.
That's the wonderful part.
Yeah,
That's
you
to
got
be
to
able to
tell me.
trust your loan
Yes,
officer.
yes,
Absolutely.
I could see why they would think that,
Yes.
because even if you're renting a home or apartment complex, that kind of thing, that is something that they say, like
Background check.
Absolutely.
Right.
So I could see how one would make you think
That's right.
the other.
Yeah,
but That's great
absolutely.
information.
Listen, if we did background checks on all borrowers, we probably would have half the business that we have.
Yeah.
Right?
Right.
Because I'm glad we don't. And we don't want to give anybody any ideas. We check enough, right? But we're really interested in, are you going to pay us back? And how have you
it.
demonstrated that you can? So
Your ability.
Yeah.
Got that.
All right,
Your
another
turn,
little one.
Shelley.
All right. Let's see what we've got here. It says, her question is, my husband is deceased, but he was a disabled veteran. I'm being told I'm eligible for his VA disability income. Is this true?
That's a very good question. So when it comes to VA disabled veterans, the general rule is if the disabled veteran died as a result of the disability,
Okay.
So we're talking about a disability that was caused from the time in the military.
Military, okay.
And if ultimately that veteran's death was the result of that, then it's very likely, I mean, I'm not a VA specialist, I'm just saying that typically is who the surviving spouse then becomes eligible for the benefit.
Okay.
May not be dollar for dollar, I don't know how that works. But if that person needs to check with the VA, very likely could be eligible for a benefit, but it's a disabled veteran, disability came from the result of being in the military, and ultimately that is what caused the death of the veteran.
Okay.
Yep.
So let's piggyback on that. So even if there had not been a disability, the fact that the veteran passed in the war or what have you, how does that? Of course, we haven't had a war in a while. I'm trying to figure out. I know there's another situation where the wife can benefit.
Possibly. That one I'm not
Okay.
familiar with.
Alrighty.
Because there are different situations. But I would just say to anybody who is connected to a deceased or a disabled veteran, deceased veteran who maybe was disabled or not, maybe possibly passed or was killed during wartime or while they were in the military, reach out to the VA. If you're the spouse of that person. And sometimes now I do get a lot of calls from kids of veterans who say, Diana, my mom or my dad was a veteran, they're deceased, am I entitled to the mortgage, the 100% financing? They are not, okay, they are not. I was gonna say, and in the case, let's say this person is entitled to, the disability income, they also get entitled to the 100% financing. So
okay.
it passes on, like the income and the loan benefit can pass
Okay.
on too, so yeah.
Okay. All right, let's see. This one was kind of trying to hide. All right, Diana, we've been considering selling our home to buy a larger one since we need more space. The problem we're having is finding another home that suits our needs. We love our neighborhood, our neighbors, and our school system. As we've been driving around, we are noticing homes that are being renovated. In some cases, they're adding on a second level. Is there a loan program that allows for these major renovations?
Glad you asked. Yes, there is. And I tell you what, I have noticed some second levels being added on too. Have no idea how much that project costs, but the bottom line is, that is, yes, there are renovation loans. There's renovation loans. FHA offers a couple of different types. One for small repairs or improvements, appliances, small projects under 30,000, under 35,000. And then there's the standard FHA, which can go up, hundreds of thousands of dollars, just depending. And a room addition or upper level addition is perfectly okay and a great option, especially in this market, especially when a person likes their neighborhood, their school system's working for the kids. I think the renovation loan and just looking at maybe renovating your home, expanding your space is a great option, just in making a decision whether you're going to sell or not.
Does that work for both buying and, because it sounds like that they have their house they just need more of it. But is that program also available if you're going to buy a home and you're like, well, we can afford this,
Yes.
but we need a little extra space?
Yes.
Okay.
So if
great.
you are buying a home and you want to add the renovation at that point that you're purchasing the home, that is not a problem. Depending on the scope of the work, you probably are going to need a general contractor. It takes a minute to close on those homes. The key to the success of that program is going to be the general contractor. So depending on how much work is involved, it can close typically in 30 days, sometimes 60.
Okay.
The work then, so we close first, put the money in an escrow account, and then you typically have 6 months to finish the job. So yes.
Okay. I can see that, especially with when weather changes and that kind of thing, depending
Exactly.
on what happens as you build more.
Yeah.
It's your turn, Janice.
Is it?
It is your turn, I think so.
Oh,
Maybe, is it? We have no clue. I'll go.
go right ahead. I was thinking of something that when you guys
Probably
were
wasn't
talking.
your question. I'm so sorry.
Yeah.
Okay, so my friend just sold her home and she received a lot less money back than what she expected. She said she was told that it was a second mortgage from HUD to help when she got behind with her payments during COVID. However, she said it should have been a grant and therefore forgiven. Although you were not her loan officer, oh, I love this. I told her I was going to reach out to you to get a better understanding, since that is what you and Miss Janice do on the Home and Finance Show. How sweet is that? I love that.
Yeah, so we've come in, Janice and I both have dealt with this situation.
Very, very,
Yes,
a lot.
A lot. And so essentially, it's either one of two types of help that buyers have typically received who get behind. And there's a second loan. That is a HUD.
Partial claim.
What do they call it? Partial claim. Mm-hmm. And that's where you have an FHA loan. So you have an FHA loan, you get behind, you know, go through the mitigation process with the lender. They take you through a bunch of, you know, show me this, show me that, to determine if you qualify. If you qualify, then you're borrowing money from HUD to catch up your mortgage. And then that becomes a second lien on the property. That is never forgiven to my knowledge.
Never.
Even when, I know when Janice was negotiating short sales, right? Even when negotiating short sales, they're not taking less. You know, the lender might be taking less on the loan, but on that loan, they're not taking less. That's why you pay the FHA mortgage insurance. So that's why when people complain about FHA mortgage insurance, they say you should never, because this help is out there to keep you in your home. So you pay it back, never forgiven. The other is could possibly be the hardest hit program.
Yes, that happens.
That hardest hit program, I think it's forgiven after 10 years, but what people, so, you know, in human nature, I'm so excited about getting some help.
And staying in my house, yes.
And staying in my house. Don't pay so much attention to the terms, but we do hear forgiven. We may not hear that it's not forgiven.
For 10 years.
We hear forgiven. So the way the hardest hit program typically works, I think, was that first 5 years, if you sold your house, you paid the full amount back maybe, and then starting in year 6 maybe, and I could have this wrong, it could be year 5, but nonetheless, a pro rata portion is forgiven each year until 10 years you're totally forgiven. Okay. So yeah, but you know, at the end of the day, what the problem is you don't get any monthly statements, you don't get annual statements. I know of no statements you get with either one of those programs to remind you.
Yeah, that's
exactly. True. It's not on your credit report, it's nowhere. But when it's time for you to, whether you're refinancing, I've ran into this with people refinancing, or like in this case, this borrower was selling, it's going to show up because it's a lien against your property.
Yeah. But it's definitely a better solution than having lost your home and gone into a financial crisis that then stays with you for 3, 5, 7 years.
Yes.
So.
And I had a customer, I think it was probably last year, maybe the year before, I can't remember, but it had happened at an earlier time of his existence in the home, you know, for whatever reasons, you know. So there wasn't any way that they even remembered it, you know.
Right.
It was really, really interesting. And they were just simply outdone. But it's just, but that you were able to stay in the house, you know.
Because those could go up as high as $30,000, I think.
I'm not sure about
hardest
the amount.
hit, it was a chunk.
Well, this was, I'm talking about the partial claim also.
Oh, okay, the partial claim, okay.
And sometimes because of the situation, you know, however, the modifying didn't work out, you know, for the loan. I have seen them when they've had both, you know, both of them, the partial claim and the, but they were able to stay in their house.
Yes.
And that's why you always have to bring it back to them,
That's
because,
right.
you know, there's all of a sudden they have amnesia. And we do that. We do that, but I bring it back to them that, hey, you are blessed to be able to stay in the home. Absolutely.
Amen.
So it's really a good thing. And again, so those who have been hearing such negative comments about FHA, you better believe it's going to be to your advantage, and VA.
That's right.
Because they're government loans, so they want you to stay in your house. They're going to do everything they can.
They understand the wealth building part of homeownership, so they want you to experience it, even if you've encountered a financial oops.
Yeah, let's see what else we got. Okay, I know how many times you get this question. We have been doing everything possible not to add any more debt since we are planning to buy a home. However, we really need to buy a car. If we get pre-approved for a home, can we then buy the car after that?
Woo, No. The short answer is no. But this is really the answer. Number one, great question. Once you've been pre-approved, any decision you make that affects your finances, you need to talk to your loan officer first. Not after you've made the decision, before you've made the decision. Because just depending on your debt ratio and your situation, possibly you're able to add a car payment. And if you are, you want to know your budget. If you're not, you want to know that as well and how that's going to impact what you qualify for. So really, once you've been pre-approved, keep in mind, basically a pre-approval is at the point in time that I looked at everything you provided me, your documents, your income, your assets, you're good for the loan this moment. If after that you open up a credit card, a negative item hits your credit report, you buy a vehicle, that changes all of that. That's not necessarily a problem as long as the numbers still work, but the only person that's going to know whether or not the numbers still work is the lender. Right. So that's why you want to keep that lender on speed dial, so that if you are in that situation where you think that this is something I'm going to have to do financially, you want to make that call. I've actually had people either borrow cars from other family members until they closed on their home, lease a car, just all kinds of creative ways of having transportation until they close on their home, because that keeps them where they need to be to qualify for their house.
Okay, so let's back up. I definitely get the fact of borrowing someone's home. The leasing part, how does that not still be an issue?
Leasing. What do you do? Rent a car to go on vacation?
Oh, rent.
Oh,
Yeah.
rental car.
Rent a car.
Okay, got it. I see.
Yeah.
Because leasing is just like possibly. Okay, gotcha.
Yeah.
Yeah. How many days do I have to close? And then I go to Avis. Look, I need this car. I like that. That could work.
And listen, let me tell you guys about leasing, real leasing, like 24 and 36 month leasing. If you are at the end of your lease, say you have 2 or 3 months on your lease, and you call the lender and you say, hey, I want to get pre-approved. In your mind, you're saying I only have 2 or 3 months on my lease, right?
Yeah.
I'm getting ready to eliminate this $500 a month payment, right?
Okay.
In our world, no, you're not, okay? Because we know that you're going to have a car.
Yeah.
So we're going to anticipate that you're going to lease another car.
Yeah, because you still have to.
You still have to
have a
drive.
car.
So
You gotta
this
go to
is
work.
one of those accounts that, while it's an installment loan and all
Wow.
that good stuff, it is a lease around transportation. And it's one thing if you're doing a lease on like a refrigerator or something like that, but it's a whole different thing on this type of thing. So kind of keep in mind, Janice, since you mentioned that, I thought that was an appropriate time. You cannot eliminate an auto lease out of your debt ratio. Unless.
That's really important to know.
Yeah, you cannot do that.
That's a big deal, yeah.
The only way that you can do it is A, you've got to show that the car has been totally surrendered, right? And B, you have to show that you have a vehicle titled in your name that you do have available, right?
To drive.
Yeah,
Okay,
to
got
drive.
it.
Because they just might think you're still 30 days difference. Okay.
Yeah.
And this has nothing to do with the car, and I think I know the answer to this, but I just didn't know if it's changed around. But there used to be a situation where you only had 10 months left on a loan.
Yeah.
Okay. So am I wrong? But I thought I heard that that's not, they're still going to consider that debt.
If the payment is more than 5% of your gross monthly income. Okay, so let's say your
Yes, put that on paper for us.
let's say your monthly income is $5,000.
Okay.
Okay, and 5% of that is $250.
Right.
Right, and let's say your payment's $200.
Right, gotcha.
Okay.
I love it.
Right. So so if the payment, if the less than 10 months or less, if the payment is more than 5% of your gross
They're
monthly
gonna count
income,
it.
we're going to count it.
Okay.
Yeah, you may have to just pay it off, but otherwise we're going to count
That
it.
would be,
Okay.
yeah, that would be,
Yep.
something interesting to do. I just wanted to know. I remember that this worked. So,
Yeah, craziness, complete craziness. This is why the rules change on a regular basis, and you cannot assume that because you've been pre-approved or pre-qualified that you're done. You just cannot assume that.
No, but something you always say is when you're getting a pre-approval, it is a snapshot.
It is a
It
snapshot.
is right now.
Right.
It's a memory.
Right.
It's a snapshot.
Right.
You've got to keep that.
That's it.
till you get to the end.
Yeah, you can't start substituting jobs and say, well, I was making this on that job, so I can make this on this job. And actually, this is going to be based on commission or bonus, and I'm going to make more on this job. So since I got approved making less on this job, surely I can get approved. It doesn't work like that.
You know, you also brought up another great point is that things change, like the rules change constantly. So even if you are a homeowner and you're buying again or refinancing, call your loan officer.
That's exactly right.
Because things have changed and see what you need to know to qualify this time around. So
speaking of things changing, one product I want to highlight real quick because I know we don't have a whole lot of time, but you know, we had that stated income program, remember? All of those programs that caused people to tell all kind of stories, right? And everything went bust. So back in the market now is called a program called the bank statement loan. It is ideal for self-employed borrowers. Okay. So, you know, we always at Home and Finance like to be able to tell you about what's going on in the marketplace so that you're aware. The bank statement loan is ideal for self-employed borrowers, and basically what is looked at to determine your income instead of your tax returns, because we know a lot of self-employed borrowers write off a lot of expense. We look at your bank statements, and we're generally looking at the last 12 months bank statements or the last 24 months bank statements. We're looking at your business deposits. We could be looking at your personal deposits also, but I'm going to stick with business right now. So if you have a business, we're going to be looking at your business deposits for the last 12 months. And if those business deposits are business deposits, so it can't be a thing where you transferred $10,000 from your personal account into your business account. That does not work. Okay. So you can't get creative. We're looking at your business deposits, okay? And then we add them all up, right, for the year or for the last 12 months, and we divide that by 12. So like I said, that says 120,000. We divide that by 12. That's 10,000 a month. We're going to allow a percentage for your expenses because most businesses have some kind of expense. And let's say, you know, that's $1,000 a month. So we're going to reduce your monthly income by 1,000, and voila, that's your monthly income.
That's interesting.
And
that's
then
good.
your debt ratio typically cannot be more than 50% of that. Okay. We've got fixed rate products. I mean, this is an outstanding program. We've got fixed rate products. We've got adjustable rate products. But this is an outstanding program for self-employed borrowers, and it is the bomb diggity bomb.
Yeah,
that's a whole show right there.
Yeah,
We'll bring it back to you.
We'll do that the next time.
Yes, exactly.
But adjusting to what's happening today.
Adjusting to what's happening today and helping our little self-employed folks, because we need them. They're the backbone of our country. Thank you so much for tuning us in today. We appreciate your time, and we look forward to next time. Thank you so much.
Bye-bye.